Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It's 10 a.m. Pacific on May 30th, shortened week due to Memorial Day in the United States. And it's been what I would say, a relatively calm week. All things considered, given the recent bouts of volatility we've experienced in markets. Let's go through the bloodless verdict of the market for the week and the month of May. Though we do have a few hours to the close, I'll give you kind of a preview on how May has gone. So this week, the S&P 500 was up 1%, even though it's selling off slightly today. And it's a pretty positive week, given the fact that the month, this has been quite a banner month for stocks, with the S&P up over 5%. And the best performing sectors on the week, interestingly, real estate was the best performer, up 2%. Second place was healthcare, up about 1.5%. Third place, consumer staples, up about 1.4%. So week to date, those are your podium places. Month to date, technology is up 8%, the big winner. Consumer discretionary up about 7.9%, another winner. And in third place, we have industrials up over 8%, 8.25%. So pretty strong month and relatively incrementally positive week for stocks. If we look at the Russell 1000 value, it's up 1% on the week, up 5.5% on the month. The small capitalization Russell 2000 up about 75 basis points on the week, up 4.7% on the month. So pretty positive numbers there. And then if we want to go into the growth space, Russell 1000 growth up 7.6% on the month, 1% on the week. And kind of shifting gears to the equally weighted space, kind of removing capitalization effects. On the week, we're relatively flat. The market's up 4 basis points on the month, up 3%. So, as you can kind of surmise by some of those technology numbers, the mega cap stocks have been driving the rallies in the month of May. Shifting gears over to fixed income land, it was a positive week in fixed income land. We had a bounce back. We had rates kind of rally across the curve. The 30-year was in 12 basis points. The 5-year was in 12 basis points. The 2-year was in 9 basis points. And where that left fixed income returns for the week, the U.S. aggregate was up 80 basis points. U.S. government securities up about 65 basis points. Mortgage-backed securities, one of the better performers, up 78 basis points. And corporate bonds were the best performing sector in the week, up a little over 1%. And even when you go onto the credit areas, high yield bonds were up 0.2%. Bank loans were up 30 basis points or 1/3%. And emerging market bonds were up 0.5%. So positive across the board in fixed income land this week, though, fixed income has had a challenging month with the kind of rate gyrations. But kind of looking on a month, the ag is down about 80 basis points on the month. And the worst performing sector is government securities, down about 113 basis points as we're recording this podcast. And most of that was driven by the increase in rates. The 30-year was up 24 basis points over the course of the month, which makes sense when you look at the credit sectors. High yield bonds were up over 1.5%, bank loans up over 1.5%, and emerging market bonds up about 1% on the month. So definitely a rate driven monthly kind of volatility in fixed income markets. Now, kind of last but not least, shifting gears to the commodity land, we take a look, and this week's been a bit of a rough week for commodities, down 2.5%, with the big loser being energy, down about 4%. Though, we have one winner there with livestock, up 1%. You can never count out commodities because there's so much idiosyncratic risk and so much diversification within the space because the sectors are so different. Kind of looking at some of the more followed sectors, industrial metals declined 2.3% this week, And precious metals actually declined 2% this week, with gold down over 2%, currently trading at $3,285 a troy ounce. Copper had a great week last week, still up 2% on the month, but down 3% this week. And crude oil is WTI crude oil is currently sitting at $60.44 a barrel, down 1.7% on the week, but up 5% on the month. So pretty volatile month in commodities, but those are the numbers. And last but not least, taking a look at the Bitcoin. Bitcoin had a banner month, up 10%, but it's fallen 4% on the week. So it's currently trading at about $104,000 per Bitcoin. And that kind of wraps up the bloodless verdict of the market. I think investors are just kind of happy that this recent bout of volatility has abated, and maybe they're just trying to wait and see as the summer season rolls in. And that kind of leads us into the macro for the week, Ryan.
Yeah, thanks, Eric. Given the shortened week, we still did get some interesting economic data points. We got an update on the consumer sentiment, and this morning we also got the kind of like the final update for April with our PCE price deflator. And the main takeaway, just to kind of sum it up, was we did see a bit of a bounce in consumer confidence, consumer sentiment, just given the U.S. China trade detente earlier in the month. And on the inflation front, it does look like inflation was trending in the right direction, at least before we see the impact, the price impact from the tariffs. So, a lot of uncertainty still to be seen, but we were in a good place, at least before the impacts from the tariffs took hold. But just kind of walk you through the economic data, just starting on Tuesday. We got headline durable good orders. The headline declined 6.3% on the month, but that wasn't entirely driven by the volatile aircraft orders, which were down over 50% on the month. If you exclude those volatile transportation components, orders were up 20 bips on the month. One category that I like to look at within the durable goods release is the non-defense capital goods orders, excluding aircrafts, versus the core shipments. And what we did see there was a 1.3% decline in the orders component, which took that orders level below the shipments level, which can be a negative signal for an investment growth going forward. So that's definitely something to watch after, I'd say, pretty strong orders data to start the year. Also on Tuesday, we got the consumer confidence data for May from the conference board. We did see a pretty significant increase, as you would expect, just given the U.S.-China trade detente. The improvement in the subcomponents was pretty broad-based, seen across expectations and current sentiment. And if you look at just the different socioeconomic subsectors, it was broad-based improvement in sentiment. And I would imagine as well that the rise in equity prices that we've seen since mid-April is also having a positive impact on consumer sentiment as well. On Wednesday, we had the Fed minutes, and those are from the May 6th to 7th FOMC meeting. And the message is, as you would expect, with the Fed basically communicating that they'll likely keep policy rates on hold until they see some deterioration in the data, and the market is on board with that view, with the market's basically pricing in only a 2% probability of a cut at the June 18th meeting. So it's really let the data prove it to the Fed for them to take any action going forward. On Thursday, we got initial jobless claims. This did seem to be a bit market moving. We saw treasuries catch a bid following the release of this report. We saw initial jobless claims spike to 240K. There is a lot of volatility in the week to week data, but one thing I would highlight is that continuing claims, we have seen a steady increase there. Continuing jobless claims, that increased 26,000 to 1.919 million, which was the highest level going back to November 2021. I am seeing some reports from the sell side basically highlighting that we maybe are seeing a bit of a pullback in labor demand. So it'll be interesting to see how the payrolls data comes in next week, which we'll get into. But the Fed is really paying particularly close attention to the health of the labor market. On Thursday, we also got the second estimate for Q1 real GDP. Nothing really to report here. Saw slight improvement in the headline real GDP number to negative 20 basis points Q over Q annualized. That was up from the initial estimate of 0.3. What I would add and what we talked about on the initial report is that this negative GDP print was nearly entirely driven by the rise in imports, just the front loading of the tariffs in Q1, and it does look like we're seeing a bit of a reversal of that, because this morning we got the goods trade balance data, the advanced release for April, and we saw a significant decline in the trade deficit. In March, the goods trade deficit was 162 billion, and that had shrunk in April to 87.6 billion. And that was, nearly entirely driven by a nearly 20% decline in imports on the month. So this should have a positive impact on Q2 headline GDP. And you're already kind of seeing that feed through into the real time GDP forecast. So if you look at the update this morning from the Atlanta Fed's GDP Now model, and they're now forecasting Q2 real GDP at 3.8% Q over Q annualized, so pretty significant uptick. But again, this is driven a lot by these volatile, what I call like non-cyclical elements of GDP. If you look through at just consumption and investment, that has remained pretty strong over the last few quarters. And then we got an update on the inflation front this morning. We got April PCE price deflator. It was another positive print, at least for the Fed and achieving their 2% inflation targets. So the headline PCE number, that we saw a rise of 10 basis points, which was in line with expectations, but it's back-to-back months of soft prints. That brought the year-over-year pace to 2.1%, near the Fed's 2% target. Looking at the core PCE, that rose 12 basis points month over month, in line with consensus, and again, another soft print following March's positive 9 basis points. And then that led to a year-over-year core PCE to decelerate to 2.5%, which was the lowest rate since April of 2021. Basically, when we're seeing the surge in inflation. When you look through the underlying components of the PCE price data, it does look like the deceleration was driven by some volatile components. Although we did see core services decelerate to 7 basis points, bit of a pickup in durable goods, which rose 48 bips on the month. But super core, we saw that decline month over month, which is encouraging. Obviously that is more tied to wages. So just looking at it, as I said before, heading into the turmoil and potential impacts from tariffs, the inflation was moving in the right direction. So we'll just have to wait and see, how much of this tariff impact feeds through into consumer prices. This morning, we also got in the same report an update on personal income and spending. Personal income, we did see a rise there of 80 basis points month over month. However, that was driven by kind of one-off adjustments to Social Security transfer payments. If you look at more, I guess you'd call it like core compensation, looking at wage income, that rose 50 basis points on the month, which is, pretty solid income growth, and if you pull it back and look at inflation adjusted income of wages and salaries, that grew at 2.5%. So, that should continue to feed into, positive or healthy consumer or consumption going forward. And then this morning we also got the final release of the University of Michigan consumer sentiment for May. And as you'd expect, we did see an improvement in the headline number from the original estimate, which came out right around the date of the I guess you'd call it the Trump trade capitulation. And we did see some positive developments in the inflation expectations, which, we saw inflation expectations decline from the original estimates, although still relatively high. I believe it was the 1-year inflation expectations dropped to 6.2%, while the longer term, 5 to 10-year inflation expectations we're hovering around 4.2%, which is extremely elevated relative to history. But as I've said in the past, you're not really seeing significant rises in inflation expectations across, the market-based measures where you're seeing, 5 and 10-year inflation break evens around 2.4%, and 1-year inflation swaps are around 3.2%. So this is quite the anomaly. It might be, there might be some political bias being driven into these consumer numbers here. But we'll just have to wait and see what actually transpires with the inflation data. So with that, Eric, I'll pass it back to you.
Yeah, Kimmel, that was pretty comprehensive, and I agree with your assessments on the general thing, like the general state of the data coming in. Definitely positive inflation print, though there's still this kind of cloud of, the tariff impact hanging over the confidence of the Federal Reserve. One thing I did find interesting in the personal income and personal spending report that I'll just briefly mention is the personal spending report came in at positive 0.2%, but if you analyze that and like dug into the details, what you'd see is good spending was down and durable good spending was down and non-durables was kind of down, but services was up. So I mean, I guess what's the point there? At least for me, how I interpret that is people are worried about goods price inflation naturally because of tariffs. And so maybe people are tightening their belt a little bit when it comes to purchasing goods, especially if they see sticker shock. If the price of a bottle of wine doubles, you're probably not going to buy that wine. Maybe it's going to be a kind of a beer week for that consumer. Or, if a person goes to purchase a durable good and they see that price up 10% plus, they may have second thoughts on spending that money. So I just think that that's an interesting tidbit from the personal income and spending report. And consumers do have a choice. They do have a choice not to consume many of these items that the United States imports. So something to keep in mind that it's not just like, oh, the tariff prices are gonna go up and then people have to buy all those goods. They can make adjustments in their purchasing basket. So I think that with that, we'll kind of jump into give you a little preview on the week ahead. As Ryan mentioned, the Federal Reserve looks like it's just going to be sitting on its hands again in June on their meeting on June 18th. I mean, the current probability in the market of a cut is just very de minimis. Now, Trump invited Scott Bessent and Federal Reserve Chairman Jerome Powell to the Oval Office for a meeting yesterday, and Man, I would have loved to have been a fly on the wall in that one, but he naturally leaned on him to lower rates, thinks he's making a mistake, but it just doesn't look like the Fed's going to make any moves in June, barring some major shock to the financial markets. So I think it's pretty much hold pat for June. Um, July and September maybe, but the odds of the Fed doing nothing this entire year are higher than they were at the beginning of the year, and one of the Federal Reserve board members was out there saying, hey, we may not even cut. And I think sometimes those communications are put out there just to manage expectations. So I think that investors investors are kind of just begrudgingly accepting higher rates for now, and that's kind of where we're at. Now, kind of turning our head to the week ahead, I would say the main thing to keep your eye on is the Friday jobs report. That's going to be exciting. That's going to be interesting. I mean, that's so Friday, June 6th, definitely tune in for that. There's going to be interesting information coming out. That's going to be the jobs report for the month of May. And I think it's an important data point and everybody's going to be looking at it. So that's going to be a key thing. Um, Monday, we do get ISM manufacturing. And so the wonks are going to be looking at that. The estimate is 49.2. Tuesday, we get jolts, which, jolts you take with a grain of salt, but the estimate's at 7.1 million. We'll see. The prior was at about 7.2 million, so maybe the labor market's tightening in according to the jolts a little bit. And Wednesday, we also get the ADP employment. I take that with a grain of salt, honestly. And on Wednesday, we get the ISM services index coming in. That's estimated to be at 52, so in the expansionary territory. And for you Fed sleuths and Fed watchers, we get the Beige book on Wednesday as well. And then Thursday, it's we get the initial jobless claims and the continuing claims. And as Ryan highlighted, those were a little elevated. So that's something to keep an eye on, actually. If those numbers are higher again, I think that you would be remiss not to pay attention to that. So that's kind of my take on the week ahead. What do you have to say, Ryan?
Yeah, as you mentioned, I think that the market is really going to focus on the payrolls report on Friday. I have been reading some interesting commentary on the some strategists think that we might see an uptick in the unemployment rate to 4.3, which would be kind of interesting because I believe that would be around a cycle high, and maybe that would get the Fed's attention to a degree. I don't think they would make a move on that. You probably need to see the unemployment rate go up to 4.5 or above for them to start to really start communicating cuts in the future. But yeah, that Friday number is going to be really interesting to watch. And a lot of this data is interesting too. Like even the surveys that you mentioned, the ISMs, those are going to kind of reflect the what you would imagine would be an uptick in sentiment just following the reversal of the trade tariffs in early May. So there's a lot of moving pieces going on right now, and I think this slew of economic data will be pretty interesting.
Yeah, I agree. So stay tuned for next week and we'll keep you updated on all those changes. And as always, tune in. And that wraps it up for the week.
Yes, thank you to all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. And you can check out the latest and greatest that we have there.
Thanks, everyone. Take care.
Yep, thanks, and have a good weekend.